and click OK, and I think we're good. All right. And welcome, ladies and gentlemen, to Forex 101, the ABCs of Forex. My name is Greg McLeod. I'm a trader, currency analyst, and an instructor and trainer. I have 20 years of experience in the Forex market, and it just makes me so happy to see new people come into the market and discover the Forex. And I see Anna and Ben, Ian, John, Junie, Kate, Peter, Prince, Sean, Steve, Tarek. Glad to have you aboard, and all those who are watching by video, but it's great to have you here as well. And let's go ahead and proceed, get moving. We got about 45 minutes. We're going to basically cover this $5.1 trillion market in about 45 minutes. And it's never enough time, but let's go ahead. Now, while you're here, we got a special bonus for you, and I get employees and their relatives are not eligible, so I can't get it, but you can. It's a $500 account raffle coming up at the end of day 1 and 2. Who will be the big winner today? So stick around. We'll have a lot of great material for you to cover. Some great speakers, Tom Long. You have Rich Crevo. A lot of fantastic things that are coming along as well. So make sure that you stick around for this raffle. It's a good start to your account to be able to win that, and also to get some good information too. So it makes sense, get it, sense, C-E-N-T-S, to stick around for all this good information and a chance to win $500. 500 big ones for your already trade account. Okay, and so this is again to give us your feedback after the boot camp. Open a live or FX trading account by March 31st, 2015, and receive $50 to start trading with an RX FX live account. Further details will be made available during the boot camp. And is there anyone supposed to speak for me ahead of time? Is Dan? Are you here?
Yeah,
yes, I'm on.
I'm here, Greg, and so everybody. So I will be. So we have multiple sessions today that will be running.
Well, you're cutting in and out.
Hours. Hopefully, in your time zone, push through there with the assistance needed. But at the very tail end, we will be doing a raffle from today, which were quite a few. Everybody has good a chance as everybody else, so stick around at that account. And we'll be having quick reminders. Each of these webinars will last roughly 45 to 50 minutes, so there will be about a 10 to 15 minute break after every session, just so you can go get more coffee if that's what you need, or take a quick break. And each new webinar will start again at the top of the hour, so just basically be back in front of your top of the hour as you can next session. And we do that. I will come back each time to remind you, and back over to Greg to keep going. Thanks, Greg.
All right, thanks a lot, Dan. That's Dan Perry, and we're going to hear more from him later on too. So let's go ahead and get going, get the party started here. And I just want to direct your attention to the risk disclosure on your screen to make sure you understand all the risks associated with foreign exchange trading. And a little bit about myself. I'm a professional trader. I've been trading in the markets for 20 years, and I've worked for one of the world's largest Forex broker-dealers in the world for 8 years of that time. And I've hosted Pip and Run Scalping, live trading. Scalping is short-term, high-speed trading, and I've taught thousands how to do that. And stay tuned. I have a webinar with that to teach people how to do that, how to get in and out of the market in a matter of minutes. And so I look forward to teaching you that for those of you who are sticking around. I hope you do stick around because we got a lot of great material to cover. Okay, so I look forward to working with you. I work with specific ORFX account holders and helping them reach their trading goals. So make sure you be part of this great organization, ORFX. And I want to thank them very much for the opportunity to be able to share with you. They're a great outfit to sponsor this free seminar with all this great material. Okay, let's get to it. Okay, currency trading basics. Okay, we're talking about this $5.1 trillion market. It takes months, years for this U.S. stock market to even equal 1 day on the Forex. But let's get down to what it is. Okay, the currency trading basics. the on the spot or spot forex. When you hear the word spot, it means right there, not the future, not the past, but the spot on the spot is the FX market or forex market. Forex stands for foreign exchange. Say foreign exchange. You put foreign. Oh, put a little far. Please, your mic a little far from your mouth, please. Okay. All right. Sorry. Thank you. Um, Anna, is it difficult to hear? Am I coming okay? Okay, let me know. Uh, testing, testing, 1, 2, 3. Anna, am I? Let me know if I'm doing coming okay, coming through clear. Okay. Prince, I'm good. Okay, sounds clear. Good. Okay, I just want to make sure everyone can hear me. Yeah, on the spot or spot forex is the largest, most dynamic market in the world. It stands for foreign exchange. That's where we get the word forex, and it's the currency market, and it's a worldwide exchange. It's decentralized. That means there's no central hub like like the, the, the New York Stock Exchange or the ASX exchange or the FTSE or the FTSE MIB. It's a decentralized market. It's an over-the-counter market, which means that these currencies are traded, over the counter via, different liquidity providers, different brokers, different. They're their own little worlds. Everywhere from an airport to a big corporation or a bank is making prices in this market. So a lot of people are involved in the currency market. You've got big companies like Apple, Fiat, Toyota. In fact, one year Mercedes-Benz made more money trading forex than they did selling cars. Porsche did the same thing. So everything from mean payroll to buying and merging companies, paying payroll around the world. There's money constantly circulating around like the lifeblood of the planet. Okay. Now, this market is a true 24-hour market, starting trading when Asia opens and transitioning smoothly from market to market across the globe. This is where money never sleeps, so it's very good if you are working. For instance, we got Kate, you're in New Zealand, and it's a top of the morning to you, and hey, that's where it starts. Wellington, New Zealand, that's where the market opens, and as the sun moves, as the Earth moves around the sun, as a rotation, so does money go from New Zealand, and the trading day opens there and moves to Australia and Tokyo, and then London, and then New York, and then New York ends, and Australia and New Zealand starts again. So whatever time you have to trade, that's why a lot of people love the Forex market, because it can fit to your schedule. Whenever you have time, the market is there for you, and there's always a banking center that's open where you can trade. Now, some money centers or sometimes are more liquid than others, and we'll talk about that later. But Tokyo starts at 7 p.m. Eastern time, which is midnight London time, and 9 p.m. or 9 a.m. Tokyo time, and that's 0 GMT. And we can see that Tokyo ends at 4 a.m. Eastern time, and then London it comes on a little bit later than London start. And there's an overlap between London and and New York, and that overlap provides a lot of liquidity as well. And then you have overlaps between Tokyo and Australia. And usually when we have an overlapping of a couple of sessions, we have a lot of liquidity and a lot of great trading opportunities. Now the trading day commences in Sydney, Australia, or Wellington, New Zealand at 5 p.m. Eastern time, daylight time. 2 hours later, Tokyo opens at 7. Next is Singapore and Hong Kong at 9 p.m. They've got the European markets in Frankfurt at 2 a.m. Eastern time, and then London, one of my favorite times to trade, is at 3 a.m. Eastern time. It's real early here where I am in Dallas, Texas, but I love getting up and trading that London session. London is considered the capital of Forex, and there's a lot of volume, a lot of liquidity generated in that London session, that first hour. And by 4 a.m. Eastern time, the European markets are in full swing, and Asia has concluded their trading day. And the U.S. markets open first in New York around 8 a.m. Eastern time, and I like trading that opening bell about 9:30 Eastern time. That's when we get the U.S. stock market opening, and we see some great liquidity surging into the Forex market as well. Now, Europe starts to wind down by about 11 or 12, but by about 11 o'clock Eastern time. And then by 5 p.m. Eastern Time, Sydney's ready to open again. So you have 24-hour market access around the clock. Now, let's talk about what we're actually trading. Now, when we talk about trading, now if you're trading stocks, you're buying IBM, or if you're buying futures, you're buying cattle futures or oil. But what are you doing when you're buying currency? What is it? Well, what you're doing is you're buying one and selling the other. It's traded in pairs, currency pairs. So it's a euro versus the U.S. dollar. And if you are buying that pair, buying the euro versus US dollar, you're buying the euro and basically selling the dollar. But it's all done in a seamless process. You just click the buy button here, and you have the ability to buy the euro, and basically you're betting or believing that the euro is stronger than the US dollar. Now this may seem a little odd, but guess what? If you buy a stock like IBM and you're using US dollars, and if you were to write it as a currency pair, it would be IBM versus US dollar. Why? Because you're trading dollars to buy IBM stock. Or if you go to the local store and buy a gallon of milk, it's milk / Australian dollar. If you live in Australia, you're trading, you're shorting Aussie dollars, and you're buying milk. You're going long milk. So it'll be milk / AUD, okay? Or maybe you're buying a car, or you're buying a BMW. You're long BMW and short US dollars, right? Because you're exchanging one for the other. So the way the currency pairs are quoted in two-way quotes, 72 by 70, and there's something called a spread. The spread is a cost of doing business. So, the broker's not going to do it for free, so there's usually a little bit of a spread. Now, this is kind of a high spread. I know some of the brokers have the lower spreads now, but 70 by 72 means that you can buy at 72, and if you wanted to sell, you'd sell at 70. Okay, so that is the bid ask. You would buy if on the platform. It's very simple. You just click this buy button right here, and then you're in the market. And a little bit more about that. So we're looking at now, like in stocks. If you're coming from stocks, how many of you guys are coming from stocks? Anybody hit trade stocks before? Anybody? No? Okay. How about the shares, stocks, or maybe futures? Okay, you're brand new. That's really cool. Okay, because you like say, okay, we talk about points, but this is brand new to you. So we look at pips, and pips. That's how we know how we've done in the market. We measure our profits and losses in pips. So how much is one pip? Pips. These are the smallest digits in the currency pair. So for the example, in the euro, was to move from 1.4339 to 1.4040, that is an increase of 1 pip. Now I ignore that little tiny number. That's a fractional pip. Okay, that's a fractional pip, and so I just go with the 4 digits and go. If we go from 39 to 40, that's a move of 1 pip. Okay, so 1 pip. If you are trading a micro lot, most pairs it's 10 cents. And if you're trading a 10K lot, it's usually $1. All currencies are traded in pairs. Consequently, when trading FX, you're always buying one currency and selling the other, which I mentioned earlier. So the value of the pip is going to vary depending on the currency pair traded. For all pairs that have 4 digits after a decimal point, the pip value is 1/10,000th of a currency pair's price. 1/10,000th. Wow, that's good. You're making a lot of money, right? Well, and that's where leverage comes in to help increase the amount of money you make on each pip, and we'll talk about that in a little bit later. But this is like a typical platform you would see with the two-way quote, the buy price and the sell price. Think of it like a wholesale and retail price. There's always the pairs are always quoted in 2 prices, and while they're buying the pound like at 57, if we thought that was going higher, but if we felt that was going to go lower, we can easily go short and press the sell button and sell it at 54 because we believe it's going down. Okay, but let's continue. Okay, So how do we trade? I mean, now that you guys got a rough idea of about pip, got an understanding of the currency pair, but what are we doing? Well, think of it. It's just like anything that you do when you're starting a business. You know, whether you're selling cookies or widgets, you want to get something at a low price, and you want to buy low and you tell me. Type in the chat box. Buy low and sell high. Right? That's right, Steve. There he goes, Steve, Stevie boy. Thank you so much. Yeah, you want to buy low and sell high. Now, if you were to chart this or plot this out, that's support. That's support. Think of it as a floor, okay? And this is like a ball, and it bounces on the floor, and you want to buy near the floor, and you know that price hits the floor or the ball hits the floor, it's going to bounce up, right? So usually, when price hits an area that's been hit several times, usually, not all the time, it bounces up. Now we can take that tendency that if price comes to a level of support, it gives us an indication that it could go higher. So if this is like at 0 or 10, and this goes up to 20, every time it's hit 10, it moves up to 20, right? So next time it comes back down to 10 again, I'm buying. And if I did that several times, I could buy low, sell high, buy low, sell high. Okay? So that's what we're looking for. We're looking for the floor of price, and we're looking for a ceiling. And this support and resistance takes on different things. We're looking at support right now. So support is a stronger every time that price respects the support line, and if high volumes are traded at support level. So it's where people say, hey, you know what? This is a good price. I want to buy it. And if it ever comes back down to that price, I want to buy because it's at a bargain. Okay. Now, the next thing we're going to talk about is resistance. Resistance is like a ceiling. It's like, if you took a ball and then you bounced it on the ground really hard and it bounced up to the ceiling, guess what? It would bounce back down. Well, gravity here would actually pull it down. But in this case, think of the ball bouncing up and it came back down and it came back up and hit the ceiling again. Okay? This acts as a cap to price. Price can't seem to get above the ceiling. We could sell first, right, and buy back. We could sell it high and buy it back low. That's selling short. We can make money on the way down, just like making money on the way up. So being able to identify where there's a floor and where there's a ceiling, where prices stop moving to the top side, finding a floor where the prices stop going down, that's what we're looking for. We can buy low and sell high, or reverse it, sell high and buy back low. So, and that's very important. And so this is what this looks like. We saw an idealized look at that. Now we're looking at a chart, and this is a chart of the pound Swiss, and this is a daily chart. Each bar represents 1 day of price action. So it kind of took a long time to get up here, but we can see that once we've established a couple of areas, we can say that if price ever got back here, we could sell. And if it ever got back down to this low, this 2.245, we can buy. So let's say it took off, and you go, oh, it took off, I missed it. Well, and then price comes back down, and hey, you can jump on the bus. The bus is going back up, all right? Hits the ceiling, we take profit. Comes back down, we buy again. Rallies back up and takes profit, and then drops back down, we buy again. So we buy low and sell high, okay? And the distance from our entry to our exit is the reward. You can place a stop below the low. A stop is a way we can say, you know what, if this starts going down and goes against us, we can get out of the trade and take the loss because maybe this level is no longer holding. That's the amount we have at risk on the trade. Okay, we want to place a protective stop or an order to get out of the trade in case this does not hold. In case this floor breaks and prices keep falling down, we will get stopped out, and that's fine because it will protect our account. Remember the bouncing ball. We want to buy at the floor, sell at the ceiling, wash, rinse, and repeat. Okay, So we want to identify a trading range. In fact, most traders you'll find have great success when they can identify these larger trading ranges. Why? Because you can tell. I mean, now in hindsight, it's 2020, you can see the whole thing. But if you back this chart up and you only saw this part, you would probably say, okay, we've stopped at this area several times. We would probably look to sell here and buy back here next time it came back down. Okay, so let's look at that. So we're going to stay tuned for understanding currency pairs, CFDs, and metals and energy. That's going to be a more detailed slide that's coming up. And I think did we go through that? Okay, I went through all those pretty quickly, but I want to know if you have any questions. Go ahead and post them in the chat box, and we'll open up to some question and answers. Got through that pretty quickly. Just remember that you stick around. We do have that $5 account raffle, and I think Dan's coming on the line. Or not? Okay, if not, let's see if you have any questions about the market or any questions about Forex. Let's see, Ben, are you typing? I get some people typing. Yes, you most certainly can, Ben. In fact, that's called a breakout. When we have prices breaking below a level of support, that's called a breakout, because now everyone that was trading that range, that range could actually keep, that range no longer, that floor is gone. So now price can flow freely and keep flowing very quickly and start trending, okay? And we can, playing breakouts is risky because, we don't know if that's going to be a false breakout, but usually once prices start moving out of that particular range, you'll see some bigger moves. So in fact, let's go back to that slide that we have on the chart. Okay, and let's say we did break out. Usually, like this is a big rectangle. This rectangle, let's say this is 100 pips wide, 100 pips. So if you were trading a 10K lot, it's $100 range. It's a bit bigger than that. But usually the height of the range of the width from the top to the bottom, and if we break out, we usually break out the same distance. So if this is 100 and we have a breakout, usually price will move 100 in that direction. Okay. In fact, I teach an opening range breakout strategy, which takes advantage of that. We get these types of ranges going on every day at 9:30, between 9 and 9:30 Eastern time, and that's just before the New York Open. We have these tight ranges, and these ranges may be 10 to 15 pips wide, and when they break out, they can be huge moves to the upside. And usually we find those just before the markets will start to, the different currencies, the majors in particular, will range before the stock market opens, and then you get these breakouts. And those are great because if this is, say this is 15 pips wide, you can place your stop below the range, and then when things break out, then you can start moving your stop up in that direction. And that's a more advanced strategy. In fact, Tom Long teaches a course on breakouts, breakout trading. Okay, great question, Ben. Keep those questions coming. And Steve, how much do you rely on government finance to determine the price of the trade? And yeah, that's very. I think we'll be doing one on trading the news, but a lot of times these price movements can be affected by, like you say, government finance or government release of economic data. We call it economic data, such as employment. The big number coming up this week is non-farm payroll. Comes up this Friday, March 6th at 8:30 a.m. Eastern Time. It's the U.S. jobs report, and it's one of the most watched economic releases in the world. And so we could see price movements of hundreds of pips. In fact, I've done some videos on YouTube trading NFP, and made like I think last NFP I made like 28 pips in about like 30 seconds. It's huge. So it's not for the faint of heart. But I am doing a news. Stay tuned for a news trading workshop I'm going to be doing as part of this boot camp. So it's a very good question. Uh, Employment, housing numbers, um, interest rate announcements like Aussie or RBA, the Reserve Bank of Australia, had a big um, announcement. A lot of people thought they were going to cut rates from 2.25% to 2%, and guess what? Head fake, head fake. They didn't cut rates. They kept rates unchanged, and the Aussie shot up. And we went from maybe like the 77, 75 area all the way up to like 78.25. I think we rounded up as high as 0.7840, because everyone was betting on our interest rate cut, and they didn't have a cut. And one reason why they didn't have a cut, and many probably who are Australian probably know about the red hot housing market that's going on there in Australia. And if you cut rates, what are you going to do? Hey, I'm from California originally, and I know when rates were low, the people were buying houses left and right, and the prices were going through the roof. And then that's what caused a big bubble. So they want to avoid a bubble, and cutting rates would probably just only exacerbate the situation. And so the traders that were with me, we saw all kinds of signals that they weren't going to cut, and we took a position. In fact, I got long Aussie dollar beforehand and grabbed a really fast trade on that. So sometimes in price, if you look at price is everything, usually if there's big movers in the market, you're going to see their footprints in price charts. You're going to see them in these different price patterns. And if you stick around there for the other webinars, you're going to learn about price patterns and how these little squiggles, there is some order to them, and you may not know that now, but these chart patterns have a language of their own, and it takes a little bit to learn it, but once you know it, that's not the hard part. I want to tell you guys, you guys are new to trading. I want to tell you something. This stuff you're going to learn, you say, wow, there's so much to learn, Greg. I got the support and resistance and breakouts and pips and currency pairs. That stuff will be easy. It's going to be a piece of cake. The psychology behind trading and battling greed and fear, those two emotions, is about, like Yogi Berra said, it's like 50% skill and 50% knowledge and 50% practice and about 90%, psychology or something like that. It's like, well, that's more than 100%, Yogi. But it is a psychology. It's a mental game that being able to stick to your plan, even though you see certain things happening in price, you have a plan, and you're not reacting to the market, but you're actually, being proactive, making your trading plan ahead of time, and sticking with your plan. And that will be, so I want to just encourage you to continue to be students, to continue to learn like you're doing. I commend all of you for being here, because I was on the other side, sitting in the chair like you, listening to some guy many years ago about how great the markets were. And I just want to encourage you that it may be rough at first, but it'll be worth it. So stick with it. It's like anything else. If you practice and study, and learn the business and control your emotions, you have a good chance at being successful. Okay. Any other questions? Keep them coming. Anything you want to know, I'm happy to answer your questions. I just have the slide presentation. The other thing that moved the markets, and I think we're going to, I don't want to steal the fire from other people, but other things that move the market other than government finance is the economic releases, Steve, is interest rates. Like if interest rates are going up in a country, a lot of people want to move their money where there's a high interest rate. It's like, hey, wow, Australia has 2.3%. I got -% over here in Switzerland. Well, let me get my money out of here and put it at some place where I can get more interest. So money follows yield, and so we'll see money flow into different currencies that have higher interest rates. Okay, and so Steve asks, what is a pip worth? Great question. On average, a pip is worth, it's based on how much margin. Actually, no, 1 pip on a micro account is worth 10 cents. Okay. Now, if you have if you're trading micro lots, you're basically controlling 1,000 units of currency, and it's roughly 10 cents. And it varies from currency pair to currency pair based on conversion rates. And it may be 13 cents, and it may be 9 cents, and some pairs maybe 7 cents, but it's roughly 10 cents for a 1,000K lot. Now, and when you trade a mini lot, and I know our 10,000 unit position, then each pip is $1. Okay, $1. And if you're trading a 100K lot or a standard lot, then each pip is worth $10. $10 a pip. So it's different based on how much margin you're putting up, what size position you're controlling, determines what size, how many pips you're actually making. So a move, if you're trading a 100K lot and it moves up 1 pip, you make $10. And if it moves up 100 pips, then you made $1,000. But if you're trading a 1,000K lot, then a micro lot, then you're making 10 cents a pip, and 10 pips you make $1, and 100 pips you make $10. And so Ben asks, how much time per day do profitable traders spend looking at the market? And that all depends how much preparation that you are. Like for instance, I might spend that Sunday looking at charts, and I might spend maybe a couple hours looking at support and resistance levels, looking at the economic calendar to see what news is coming up, and just flying out what pairs may be that are hot. What's popping? What's hot? Usually, what you'll see is that currency pairs that have a lot of news around them will move a lot. Like we had a lot of PMI data out of Europe this morning. It was very disappointing. The Spanish PMI was down, and Eurozone PMI was down, and then we saw a big sell-off in the euro. So, but because I had an economic calendar and I studied it on Sunday, and I kind of knew what that the euro was going to be active. Also, we had a interest rate decision out in Canada, and so I knew that the Canadian dollar was something to look at, and I also knew about the Australia rate decision, and so that kind of homework, knowing about the different, because if you're trading some currency where there's no news, it definitely is, Prince. Thanks so much for coming. Appreciate you. Now, if there is news in the pair, that's the pair that's probably going to be in play because people are going to take positions. Aussie CAD just broke south and it just dropped, and because we had that, But maybe if you're trying to trade South African rand and there's no news, and maybe it's not moving anywhere. Okay. Bye, Prince. Oh yeah. Oh wow. Well, I appreciate you staying up and being here. Take care. Look forward to seeing you and talking to you later. Yeah. So definitely you want to spend time looking for these areas, like in this chart, looking for key levels of support and resistance, looking at which direction, and if something is trending, making higher highs and higher lows, the trend direction. You want to study that daily chart. You want to look at that 4-hour chart. And if you're scalping, like for me, I'm dropping down to like a 30-minute chart and maybe a 5-minute chart, even looking for trading opportunities. And so after I've identified that, in fact, I have a trader's checklist where I actually go through a checklist of the things I'm looking for to make sure that I hit those key areas each and every time that I place a trade. So I'd say about, and I told you how to build a clock and when you asked what time it was, but I hope you get the idea. Any other questions? We got a few more minutes. Love to answer your questions. And definitely want to open up a demo account. I want to advise you, open up a demo account, and that way you can practice, get a feel, because you don't want to make a mistake with with real money. You want to go get your RFX demo account and practice pressing buy and sell. Just press buy and sell. Just see what happens. Don't even worry about making any money. Just get familiar with it. Get comfortable with the platform, and I'm sure the sales associate will be able to walk you through if you a product walk through a demonstration. And then after you get into these classes with RFX, and then after that, open up a live account and trade very small. Go for that, 10 cents a pip, okay? You're playing with, you've got some real money in the account. It's actually going to, because once you learn the mechanics and you learn support and resistance, then some things happen when you trade with real money. When you have real money, all of a sudden now it's like, I'm losing money, and then all of a sudden these emotions and things kick in, and that's where the psychology gets in, and that's where your battle is going to begin. It's not going to be whether you know where support is or where stochastics is crossing or an Ichimoku cloud or whatever those things are. It's going to be, I'm losing money, what do I do? Okay, and so risking 10 cents or 20 cents a pip, will allow you to master your emotions. And if you lose, a dollar, say, okay, I lost, lost a few quid. I'm no worse for it. But, and then as you become more proficient, then you can start maybe funding your account with more money when you prove to yourself that you can be disciplined, okay, and that you can actually execute your plan in a responsible manner, and you feel good about what you're doing. You're able to prove to yourself that you can grow your account, and then you say, okay, I'll give myself a little bit more. Maybe I'll put $500 in. Maybe I'll put $1,000 in. But after you've proven to yourself with a micro account, with a small amount of money, that you have mastered it, and that you can take a loss, being able to get stopped out and take a loss, because that's the hardest thing to do, is taking a loss. People, if you're, let's say you're looking at this this chart here at the very beginning, it's making higher highs and higher lows, but that red candle starts dropping down. What do? Or here when it drops below, and you say, oh, it's going to come back. Well, if it doesn't come back, what if it does break south and keep going? What are you going to do? Well, I'm losing $10. Oh my God, what am I going to do? Lose the $10. Why? There's always another tube leaving the station. Okay, better to get stopped out and move to another trade than to let a loss go against you. Okay. Any other questions? See that. Any other? Okay, we go. See. Okay, from your experiences, how much do greed, complacence affect trader? Oh, it's like 90%. 90%, if not 99%. Because you can have the perfect plan. I'm going to buy here when price gets here. It looks like very great. See where it says risk, and that bar came right down there to that line, and then pop back up. Look at this down move. Could you actually look at that chart and actually buy it when it's going? Basically, it bounces up here, and then you're going to buy. You're probably going to be terrified. Like, I'm not going to buy that thing. It just dropped, So, so you might just stand aside, you might say, oh, I'm not going to get in yet. And then it bounces, and then it takes off, and now you want to buy it. But as soon as you buy it, it drops, and now you're mad and you get stopped out. And then it goes up again, and now so being able to, buy at support. Remember, before support, it's a down move right in your face, and so you have to have the emotion on your emotions under control and the conviction that your plan is going to work. And if your plan doesn't work, you have a contingent plan to get out of the trade if it doesn't work out. And also, when we get to the top of let's say we get to the top of this area, and you think, wow, I'm up like 100 points. I want to stay in, keep going, it drops. No, I think it's going to keep going, it drops. And we go, well, maybe, and then it keeps dropping. And then you see your profit turn to a loss because you're unwilling to take the profit. Take the bird off the screen. So you have to be able to manage those emotions. So again, see, that's you're absolutely right on. It's spot on. with that question. But it comes with, if you're a doctor and you're operating on someone, doctors operate on cadavers or dead bodies for a long time before they actually touch a real person. And why? Because they get used to cutting open things and sewing things up and splicing things together, and and they do this repeatedly. Or maybe if you're a fighter pilot, if you're a jet, you're gonna go through hours of simulation to condition your mind so it becomes routine. So you're not thrown that, oh, there's blood everywhere. What am I gonna do? But you're a doctor and you've seen this before and you've done a lot of residency, so you're condition your mind. Or if you're in an airplane and you're hitting some turbulence, well, I've been in a simulator, I've done this before, and so when you do something over and over again, you get enough seat time, enough screen time, you're going to condition your mind to where these emotions will not have as much effect because it just becomes rather routine, like driving a stick shift. When you first drove a stick shift, a manual transmission, how herky-jerky that was. But soon you learn first, second, and third, fourth gear, and then you forgot about it. You just did it. You do it automatically. It just because you're no longer worried that, oh, someone's going to rear end you, and your car's going to stall out, and you're in the middle of traffic. All those things flashing through your head when you're younger. But now that you've been doing it for a while, it becomes automatic. So the only way to overcome fear and greed is through continual practice. Practice, practice, practice. Any other questions? You guys are a great group. Awesome, awesome. Okay. With that, I'm going to leave it open for questions for a little bit longer, and I see maybe Dan will come on, and we can go ahead and maybe close and wrap this up.
Thanks, Greg. I'm back here. This is Dan back, just moderating the boot camp here overall, folks. And so this is the first of multiple sessions today. Greg will actually be back with us for the fourth session, which I think he's kind of touched upon here, common mistakes to avoid. I think some of your questions directed Greg down that path a little bit already. So if you want to hear more, Greg's 20 years of experience, as he hit upon in the beginning of the webinar, is quite valuable. So it's definitely precious to get in here and take notes and keep track of some of these tips that really are difficult to come by. I know that from experience myself as a trader in the market, and some of the things that Greg hit upon here in this webinar, I wish I knew when I first got into the markets, rather than paying my tuition inside the market itself. So and as a reminder, for I think a couple people possibly have came in
All right, can you hear me? Dan, we lost you. Okay, testing, testing, 1, 2, 3. Okay, let me go ahead and stop. I'm gonna stop the recording here.